If you're in your 50s and think it's too late to optimize your retirement tax strategy, I have some great news for you. You're actually entering the most critical decade for tax planning. And the decisions you make now could save you lots and lots of money. I'm talking tens of thousands of dollars in retirement taxes. Today we're talking about tax diversification specifically for people in their 50s and beyond. This isn't about chasing returns or taking big risks. It's about being strategic with the taxes you'll pay on the wealth you've already built. Stick around because we're going to cover some moves that could dramatically improve your retirement income. Hey everyone, welcome back to the Mike on the Money channel. I'm Mike Giordano, private wealth advisor with Williams Wealth Management. And today we're focusing on a topic that's absolutely crucial for pre-retirees: tax diversification. If you're in your 50s, you've probably got 10, 15 years left in your career. And these are your peak earning years. They're also your last chance to set up a tax-efficient retirement. Most people your age have done a great job saving. You've probably maxed out your 401k for years. But here's the problem. If all your money is in traditional retirement accounts, you're setting yourself up for a potential tax bomb in retirement. The good news? We can fix this. And we're going to show you exactly how. We'll cover why your current strategy might backfire and 3 types of accounts you need, and specific strategies for people in their 50s and 60s. So let's dive in. Let me paint a picture of what retirement looks like for most people in your situation. You've been a diligent saver, putting money into your 401k year after year. Maybe you have $800,000, $1 million, $2 million, $3 million saved up. Congratulations, that's fantastic. But here's what happens when you retire. Let's say you need $80,000 a year to maintain your lifestyle. If all your money is in traditional 401k and IRA accounts, that entire $80,000 is potentially taxable income. At today's tax rates, you could be paying $15,000, $20,000 or more in federal taxes alone, not counting state taxes. The RMD problem makes it worse. At age 73, the government forces you to start taking required minimum distributions from your traditional accounts, whether you need the money or not. If you have $1.2 million saved, your first RMD may be around $44,000. Combined with Social Security, you might be pushed into higher tax brackets than you expected. And speaking of Social Security, did you know that up to 85% of your Social Security benefits can become taxable based on other retirement income? Yeah, if you're pulling large amounts from traditional accounts, you could trigger taxes on benefits you thought were tax-free. Here's the big unknown. What will tax rates be in 10 to 20 years? With massive government debt and spending, many experts believe taxes will be higher in the future. You've been getting deductions at today's rates, but you'll pay taxes at tomorrow's potentially higher rates. This is why having all your eggs in the tax-deferred basket is risky, especially for people in their 50s who are likely in their peak earning years. So what's a possible solution? Tax diversification across 3 different types of accounts. Bucket 1 is your tax-deferred accounts, traditional 401ks, traditional IRAs. You probably already have plenty in this bucket. The money goes in tax-deductible, grows tax-deferred, but every withdrawal is taxed as ordinary income. This will likely remain your largest bucket, but it shouldn't necessarily be your only bucket. Bucket 2 is your tax-free bucket, Roth IRA, Roth 401k. This is where you pay taxes up front, but never again. For people in their 50s, Roth conversions can be particularly powerful. Yes, you'll pay taxes now, but you're essentially prepaying taxes at today's rates to avoid potentially higher rates later. Plus, Roth accounts have no required minimum distributions during your lifetime. Taxable brokerage accounts. These accounts give you flexibility. You can access the money anytime without penalties, and long-term capital gains rates are generally more favorable for most taxpayers. Currently, they're 15% for most taxpayers, on the higher end, 20%. Compare that with ordinary income tax rates that can reach 37%. All right, why this matters in your 50s. At your age, you have a unique advantage. You likely have 10 to 15 years of high earning potential left. This gives you time to build tax diversification while you're still earning and can manage the tax impact of strategies like Roth conversions. All right, let's get into some moves you might be able to make in your 50s. Look at these things as different considerations, different things to think about, different options. Everybody's strategy is going to be different. So all of these are different potential plays in your playbook, and you got to figure out maybe which ones are the best to use, or with the help of a financial advisor, figure out which ones might make the most sense for your situation. One potential strategy is maximizing catch-up contributions. Once you turn age 50, you can contribute an extra $7,500 into your 401k and an extra $1,000 into your IRA. But here's one thing to think about. Instead of just putting all the money in a tax-deferred way, in the traditional buckets, maybe consider splitting some of these contributions. Continue your traditional 401k contributions for the tax deduction, but maybe put some of the Roth catch-up contribution into a Roth 401k if your plan offers it. Strategy number 2, the mega backdoor Roth. If your 401k plan allows it, you may be able to contribute more than $60,000 a year using after-tax contributions and in-service distributions to a Roth IRA. This is incredibly powerful for high earners in their 50s. Again, got to make sure that this makes sense for your situation. Strategy number 3, strategic Roth conversions. This is huge for people in their 50s, especially if you've had any years with lower income. Maybe you're between jobs, you took a sabbatical, you have a down year in your business. This is when you might want to consider converting some traditional IRA money over to Roth. You'll pay taxes now, but at potentially lower rates than you'll face in retirement. Again, this is for people who have income that is all over the board, and you're just trying to take advantage of some strategies that might work in those lower income years. Strategy number 4 is your tax location strategy. Here you want to be strategic about what types of investments you hold in each account type. Oftentimes people are thinking about investing the exact same way in all their different accounts. But if you've got accounts that are going to be taxed in the future, like all of the money is going to be taxed, your traditional IRAs, your traditional 401ks, these tax deferred buckets, if all the money is going to be taxed, you might want to be more conservative in those accounts. And then in the accounts like Roth, IRAs and 401ks where you're not going to be taxed, maybe you're more aggressive there because all the growth is yours to keep, right? So this is something you might want to think about, is having a different strategy for different types of accounts. Strategy number 5, plan your early retirement bridge. If you're planning to retire before age 59 and a half, you'll need money to access without penalties. Build up your brokerage account. And remember, you can also withdraw Roth IRA contributions, not the gains, just the contributions penalty free at any time. There's also strategies that you can work using traditional accounts, whether it's traditional IRAs or a 401k. The rules get a little complex there, but if you're working with a financial professional, they can hopefully help you think through how you can access maybe some of that money before age 59 and a half. But this is something really important to consider, is 59 and a half is that age where a lot of the penalties come off of traditional IRAs, 401ks. But if you need the money beforehand, you got to start thinking about, okay, which ways can I access that money before age 59 and a half? All right, let's kind of put all of this together, and let's do this with a fictitious person named Janet. We'll say she's 52. She makes $120,000 a year, and she's got $750,000 in her 401k. She realizes she's heading for a tax problem. So in her case, she continues contributing $23,000 to her traditional 401k for the deduction. She puts her $7,500 catch-up contribution into a Roth 401k, and then she opens up a brokerage account and invests $10,000 annually. She plans to do small Roth conversions once she retires, but before claiming Social Security. So by age 65, potentially, Janet has $1.1 million in traditional accounts, $200,000 in Roth accounts, and $130,000 in a brokerage account. She still has the majority of the money in a traditional tax-deferred account, but now she has some flexibility to manage her tax bracket in retirement. She has money in those other buckets. All right, let's button this up. If you're in your 50s, you're in the sweet spot for retirement tax planning. You have enough time to make meaningful changes, but not so much time that you can procrastinate. The decisions you make in the next few years will determine how much of your retirement savings you actually get to keep. Remember, this isn't about earning higher returns. It's about understanding how different tax treatments might affect your retirement income. Tax diversification could potentially give you more options in managing your retirement tax situation. Here are some areas for further research. Analyze what percentage of your retirement savings is currently in each tax treatment category. Research what your potential retirement tax situation might look like. Explore whether increasing Roth contributions or conversions might fit your situation, and consider consulting with qualified professionals to analyze your specific circumstances. Tax surprises in retirement often happen to those who don't plan ahead. The fact that you're researching this topic suggests you're thinking proactively about your future. That's a great thing. That's already a few steps down the line. If this video helped you think differently about your retirement planning, please hit that like button and subscribe to this channel for more strategies specifically designed for people like you approaching retirement. You've worked hard to build your nest egg. Now let's make sure you get to keep as much of it as possible. I'll see you in the next video.